All right, let's broaden it out here as we look at stocks posting those modest declines as markets react to fresh evidence of sticky inflation. The latest PPI reading coming in above economists' expectations and seems to be another sign the Fed is likely to keep rates higher for longer. Joining us now, Lori Calvasina, RBC Capital Markets head of U.S. Equity Strategy. Lori, first of all, it's great to see you as always. Thanks so much for being with us. Not great news necessarily for investors today. And what's interesting is you got CPI and markets sort of seem to shrug it off. Now you have PPI and retail sales. Jay Powell was looking for more good data. Are we getting now more meh data that's sort of adding up?
Yeah, look, I first of all, thanks for having me. It's always great to see you as well, and be on the show. But look, I do think that this is kind of mad data. In fact, our rate strategy team did reduce the number of cuts they're anticipating from the Fed from 5 down to 3. And so they've, sort of trimmed their outlook a bit. They've always been in the June start camp, and they haven't deviated from that. I do think other investors across the street have had to do a lot more ratcheting down of their expectations. There was this big camp for March, and we've really seen that the March cut camp, has gone through some things, over the last, month or so. It hasn't been so pleasant to talk to those folks. But I do think, as I talk to some of those people and we've sort of debated what the Fed's going to do with people over the last 4 to 6 weeks, I frankly have heard some concerns about inflation potentially coming in hotter than anticipated. So I look at the fairly muted reaction in the market that we've had to both CPI and PPI, and it actually kind of makes sense to me because I do think there had already been a lot of worry among the equity crowd that maybe the inflation data was going to be a little bit bumpy on the way down.
Do you think, Lori, just to plan on a point, that maybe part of what's going on is kind of a narrative shift in that there was this storyline, Lori, out there for a while, the Fed's going to have to cut if the market's going to move higher. Do you think maybe now that's sort of changing and the focus is more, the economy is solid and earnings revisions moving in the right direction?
We are seeing a little bit of, kind of stabilization earnings estimates the last few weeks, but we did see a little bit of a ratcheting down to start the year. That is not uncommon at all. But I think what I've also noticed in client conversations is people who have been worried about whether or not the Fed is going to cut have generally phrased it as this: oh my gosh, the U.S. economy is so strong, the Fed can't possibly cut. That's sort of the extreme version of that. If you go back to last August, the concerns about the Fed were expressed a very different way. It was the Fed's just going to keep cutting or keep hiking or not going to cut, and we're going to get a recession. And so the economic narrative is just completely flipped. And if you look at just GDP forecasts themselves, they're around 1.6% in the middle of February, right actually before I went on vacation for spring break. And when I got back from spring break, they had sprung all the way up to 2%, and now they're at 2.1% right now. So we're seeing those economic forecasts move up very, very quickly. And I think even though there's all this Fed angst out there, people have really also been focused on the idea that this economy is not on the brink of recession the way a lot of people thought it was.
And do you think that there's anything in the economic data that we've gotten this week that is going to shake that newfound optimism?
So look, I think there's always going to be a bit of angst, but frankly, Julie, we just got through this reporting season where I do think companies were generally trying to talk down expectations, but that was more on the cost side. If you think about sort of the demand environment, I don't think we really heard anything new that we haven't been hearing for the last 6-9 months, which is that high-end consumers are generally pretty strong, lower-end consumers are starting to show some cracks, but things are generally holding up pretty well. And I think we just heard 500 companies from the S&P 500, and most of those told us that we're not on the brink of recession. So yes, people are going to pay attention to economic data. And there may be some hiccups here and there, but I think the preponderance of the evidence is still in favor that the Fed is going to thread the needle and pull this off.
And Lori, the strategist David Rosenberg, he was out with a note to his clients today, Lori, and he said there's 2 primary concerns for the market right now. One, he said, lofty valuations, his words, Lori, and then he also talked about what he called excessive bullish sentiment. You agree? You think those are 2 big concerns?
I agree with him on the bullish sentiment. So we watch sentiment pretty closely. And, that's one of the things that's been weighing on us a bit, in the short term, I would say. If you look at AAII net bulls, you've been above the 1 standard deviation mark in terms of net bullishness, not quite back to 2 standard deviations. When you're 2 standard deviations on the bull side, it tends to be a down market over the next 12 months. When you're above 1, but not yet back to 2, it tends to be a flat market over the next 3 months and moderate gains over the next 12. So we're in that latter camp. If you look at CFTC data on buy side positioning, net equity future positioning among the whole buy side and looking across things like NASDAQ, S&P, Dow, mid cap and small cap contracts, just the whole enchilada baked together. What you're seeing is that the positioning has been above the highs that we saw in early 2018 and early 2020 pre-COVID. We've also been well above the highs that we're seeing in 2021 and early 2022. So we do have a sentiment problem out there. I think it's begrudging bullishness. I don't think people, necessarily feel as great, as they have at some of those other peaks on the CFTC data, but it is certainly concerning on the data side. Valuation, I'll take the other side of the argument. What we see on our modeling, and we do our valuation work very, very differently from most people on the street, is that valuations are pretty fair in the context of interest rates, in the context of inflation moderating, and in the context of recovering GDP. Long story short, our model goes back to 1962. We use regression analysis for things like 10-year yields, Fed funds, GDP, and PCE for inflation. And if you look at where the consensus expectations are for those variables at the end of the year, plug them into our model, it's telling us to look for a 23.5 time or 23.3 times multiple rather at the end of the year. And that model was calling for 21 to 22 times at the end of last year and ended up being right. So I think people who, and I don't know, exactly what David's doing on his valuation work, but I know there is a tendency on the street to just sort of look at averages and say, hey, we're this far above average or this far below average, and therefore we're expensive or therefore we're cheap. And we just take an entirely a different approach to valuation, which is saying that things are pretty fair and there could actually be some upside in this market. Our model is saying 5,400 on the bull side.
All right, we'll see if we'll get that bull case scenario. Lori, great to catch up with you as always. Hope to see you again soon.
All right, have a great day.